There are sheets and sheets and sheets and sheets on banks now. And see, let's understand what the market setting is. The market setting is that rates are likely to move down. And for the first time, both globally and locally, interest rates post-COVID are likely to come down. Interest rates are like gravity. They're like weather. Just like weather has an unspoken impact on how you dress, interest rates will have an unspoken impact on how financial markets will do business and how demand dynamics would move. So that's the macro part. That interest rates, if they come down, banks would benefit, demand comes back. Within that, what's the first port of call? I think one should go for banks which currently are struggling with liabilities, or are, when I say struggling is not the right word, but they have a challenge for liabilities and are suffering because of tight liquidity. So that would include private banks, the large ones, or corporate banks, the large ones. That's the first port of call. Second port of call is that you'll have to look at NBFCs. A point I think we've been making, that wholesale denominated NBFCs, they will outperform because they borrow from the wholesale market, they lend in the retail market. And interest rates, they tend to benefit if they come down first. And third, I think that FI number, what we were saying, that look, FI have been selling the banks down, and they've been selling the banks down because they own banks and IT. There is a turn in IT which has happened, there's a turn in bank which is happening. So depending on which way you want to lean, I think banks in a sense are really at that sort of place where they are getting ready for a launch. Now I don't expect massive outperformance because everybody owns banks and everybody is waiting for this outperformance. But you may see a little bit of technical shift because if FIs come back, which they are coming back, then the selling actually reduces and the fresh domestic flows and retail flow can go back into banks.